100 Baggers, Stocks That Return 100 to 1 and How to Find Them by Christopher Mayer. Picture yourself back in 1954. You've just opened an envelope containing a doctor's bill that makes your stomach drop. $7,000. That's serious money back then, the kind that keeps you up at night. You stare at your bank statements, do the mental calculations, and finally make what seems like the only responsible choice. Sell some shares in that quirky little company, Polaroid, to cover the cost. It feels prudent, practical, the kind of decision a sensible person makes. But here's where the story gets interesting. You tuck away the confirmation slip from that sale in a drawer. Years pass. Every now and then you pull it out and glance at it. A decade goes by. Then another. And one day curiosity gets the better of you, and you crunch the numbers. Those shares you sold for $7,000? They'd be worth $843,000 now. That wasn't just a doctor's appointment. That was quite possibly the most expensive medical visit in human history. This painful tale belongs to Thomas Phelps, a brilliant investor from another era. And that single gut-wrenching mistake planted the seed for a fascinating question. What if you could identify stocks that don't just double your money, or even triple it, but multiply it by 100? That's exactly what we're exploring today, through Christopher Mayer's book, 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. Let's pause and really absorb what a 100 bagger means. Take $10,000, roughly what you'd pay for a decent used car, and watch it transform into $1 million. A single smart investment that could bankroll your retirement, fund your kids, college education, or buy you the freedom to chase dreams you've been putting off. Sounds like pure fantasy, right? Like trying to predict where lightning will strike. But here's what Christopher Mayer discovered, walking in Thomas Phelps' footsteps. These extraordinary investments aren't random acts of financial luck. They leave breadcrumbs. They follow recognizable patterns. They share telltale characteristics that, once you learn to spot them, completely transform how you see investing. And the best part? You don't need some fancy finance degree from an Ivy League school. You don't need an MBA with your name in gold letters. You certainly don't need a corner office on Wall Street. Many people who've caught these lightning bolts were regular folks who learned a few elegant principles and had the guts to trust them. So for the next while, let's set aside everything you've heard about the stock market being some dangerous, complicated casino. Forget the flashing tickers, the dizzying charts, and those confident-sounding folks on TV who claim to predict the future. By the time we're done here, you'll understand the surprisingly simple blueprint behind truly life-changing wealth. You'll discover the two powerful forces that drive every 100 bagger, the single most critical quality to hunt for in a business, and the mental game you need to master to stay in your seat for the ride. This isn't just about picking stocks, it's about learning to think like someone who actually owns a business. And that mindset shift? It'll serve you for decades to come. So where do we start hunting for these elusive 100 baggers? Well, the first truth might surprise you. The biggest obstacle isn't out there in the market somewhere. The biggest obstacle is staring back at you in the mirror. It's the battle raging between your ears. Let me share another story that'll drive this home. An investor once heard a compelling pitch from an analyst he trusted deeply. The year was 1992, and the company was Potash of Saskatchewan. The logic was straightforward. It was a clever way to tap into China's explosive growth story. Everything checked out, so he bought shares at $2 each. For 3 years he held on tight. The stock performed beautifully, multiplying his money by 4 or 5 times. He felt like a genius, like he'd unlocked some secret code to wealth. But then the stock hit a wall. It stopped climbing. For months it just sat there, treading water. And he got restless, bored. He started craving the next big thing, the next exciting story. So he sold. Here's the kicker. The original investment thesis hadn't changed one bit. Everything that made it attractive in the first place was still true. But his patience had evaporated. And if he'd just sat there doing absolutely nothing, if he'd simply resisted the urge to take action, he would have landed his 100-bagger. By 2007, those $2 shares had climbed to $200. This is the brutal, honest truth about investing that nobody likes to admit. The real money isn't made when you buy, it's made when you wait. We sabotage ourselves constantly. We panic and sell when prices drop. We get greedy and bail out too early when we're winning. We're addicted to doing something, and the entire financial industry is designed to feed that addiction. Every day the news screams that something important is happening, that you must act now. But as Thomas Phelps used to say, a lot of shavings don't make a good workman. Being busy isn't the same as getting results. Even Warren Buffett, the greatest investor alive, fell into this trap. Back in 1966, he spotted Disney's incredible potential. He bought a substantial stake for his investment partnership. After adjusting for stock splits, he paid around 31 cents per share. Today, that investment would be worth an absolute fortune. Brilliant move, right? Except it wasn't. Because just 1 year later, in 1967, he sold everything. For 48 cents per share. Sure, he pocketed a nice 55% gain, but he later admitted it was one of his most expensive mistakes. He walked away from generational wealth simply because he sold too soon. So if our biggest enemy on the road to these life-changing returns is our own inability to sit still, what's the solution? How do we protect ourselves from our worst impulses? This brings us to one of the most brilliant, yet elegantly simple ideas in the entire book, the coffee can portfolio. The concept harkens back to the Wild West days. People would stash their most precious belongings, gold coins, property deeds, family heirlooms, inside an old coffee can and hide it under their mattress. The success of that strategy had nothing to do with checking the can every day. It depended entirely on how wisely they chose what to put inside it in the first place. The investor who brought this idea to modern finance was a portfolio manager named Robert Kirby, and the way he stumbled onto it is absolutely delightful. Back in the 1950s, Kirby was managing money for a woman. For 10 years, he worked diligently on her portfolio, buying and selling stocks, trimming positions, trying to squeeze out every bit of performance. Then one day her husband died, unexpectedly. She inherited his stock portfolio and asked Kirby to take it over too. When Kirby examined the husband's holdings, he was initially amused. The husband had been quietly following all of Kirby's buy recommendations. Whenever Kirby bought a stock for the wife, the husband would buy about $5,000 worth for himself. But here's the twist. The husband completely ignored all of Kirby's sell recommendations. He never sold a single share. He'd just buy the stock, toss the certificate in his safe deposit box, and forget it existed. When Kirby totaled up the husband's portfolio value, his jaw hit the floor. Yes, there were a few losers, stocks that had withered down to a couple $1,000s. But there were also several positions that had mushroomed to over $100,000 each. And then came the knockout punch, one single holding worth $800,000, larger than his wife's entire professionally managed portfolio. That position started as a modest investment in a company called Haloid, which, as Kirby later put it, turned out to be a zillion shares of Xerox. Think about that for a moment. The husband, through what some might call benign neglect, through pure inactivity, had completely crushed the performance of the active professional. His simple, do absolutely nothing approach had shielded him from the constant temptation to fiddle, to trade, to react to every piece of news. This is the genius of the coffee can approach. It forces you to think in decades, not quarters. You only put something in your coffee can if you believe it's a fantastic 10-year bet. You find the absolute best companies you can, place them in the can, seal it shut, and metaphorically bury it in your backyard for a decade. No obsessively checking prices. No reading quarterly reports with sweaty palms. No selling. It's a psychological crutch, as the author describes it, a tool to help you hold on. Because the journey to 100-bagger territory is rarely smooth sailing. Consider Apple. From its 1980 IPO through 2012, it delivered a 225-bagger return. Phenomenal success. But to capture that return, you would have needed the stomach to endure an 80% peak-to-trough collapse. Twice. There were several other occasions when it dropped 40%. Netflix, another massive winner, lost 25% of its value in a single day not once, but 4 separate times. On its worst day, it plummeted 41%. How many of us could watch that kind of carnage without hitting the panic button and selling? Very few. But if your stocks are locked away in the coffee can, you don't even see the bloodbath. You're vaccinating yourself against your own worst instincts. You're giving your best ideas the breathing room they need to truly flourish. For an even more extreme example of the power of doing nothing, consider the Voya Corporate Leaders Trust Fund. It launched way back in 1935. The founders bought equal stakes in 30 major U.S. corporations, and the fund's charter stated they could never sell these stocks unless a company went bankrupt or got acquired. They haven't picked a new stock in 80 years. The result? This fossilized, do-nothing fund has beaten 98% of its competitors over the last 5 and 10-year periods. It's outperformed the S&P 500 for 40 consecutive years. It owns Berkshire Hathaway today only because one of its original holdings, a railroad company, got bought by Buffett. It owns ExxonMobil because it started with Standard Oil from the Rockefeller era. It's living, breathing proof of the power of buying right and holding tight. So lesson number 1 on our quest is fundamentally psychological. You must cultivate patience. You must learn to sit still. You must give your investments time to work their compounding magic. But that raises the crucial next question. If we're going to lock something away in our coffee can for a decade, what exactly should we be looking for? How do we identify these extraordinary businesses? This is where we shift from the art of holding to the science of finding. The book reveals that 100-bagger stocks are propelled by what the author calls the twin engines. Let's examine a real-world example. MTY Foods, a Canadian company. In 2003, it was tiny, a franchisor of quick-service restaurants with a market value of just $5 million. It was virtually invisible to most investors. But over the next 10 years, every dollar invested in that company grew to $100. How did this happen? First, the underlying business grew substantially. Its earnings per share, the profits allocated to each share of stock, multiplied by more than 12 times. That's impressive growth on its own. But if earnings only grew 12-fold, how did the stock grow 100-fold? The answer lies in the second engine, the multiple that investors were willing to pay for those earnings. This is typically measured by the price-to-earnings ratio, or PE. In 2003, when MTY Foods was forgotten and overlooked, investors only valued it at about 3.5 times its earnings. But by 2013, after a decade of consistent success, investor sentiment had completely shifted. They were now willing to pay 26 times its earnings. So you had this powerful 1-2 combination, the actual earnings multiplied by a factor of 12. Meanwhile, the price tag, the market slapped on each dollar of those earnings, multiplied by more than 7. When you multiply those two forces together, you get the explosive cocktail that creates a 100-bagger. This is the secret formula. You need massive growth in the underlying business, but the truly spectacular returns happen when that growth combines with the market waking up and rewarding the company with a higher valuation. Both engines firing simultaneously. This means you can't just buy any company and hope for the best. You can't pick a massive, mature giant like McDonald's or IBM today and expect a 100-bagger. The growth runway simply doesn't exist. You also can't buy an already popular, high-flying stock that everyone's talking about, and that's trading at sky-high multiples. In that case, the second engine is already maxed out. There's no room left for multiple expansion. The sweet spot, the prime hunting ground for 100-baggers, is finding companies with enormous growth potential that haven't yet been widely recognized for it. So what common threads connect these companies? After studying 365 of them over a 50-year stretch, Christopher Mayer and fellow researchers discovered a clear blueprint. One study from India captured it beautifully with the acronym SQGLP. Let's unpack that. The S stands for size is small. This might seem obvious, but it's critical. You need acorns to grow oak trees. Apple, as magnificent as it is, cannot become a 100-bagger from its current size. A 100-fold return from here would make it worth more than the entire U.S. economy. The math just doesn't work. But small doesn't mean you're hunting for sketchy 50-cent stocks with no revenue. The research found that the typical 100-bagger started with sales around $170 million. These are legitimate, established businesses. They just have a long runway of untapped growth ahead of them. The Q stands for quality is high, both in the business model and its management. This is absolutely crucial, and we'll dig deeper into it in a moment. The G stands for growth in earnings is high. We've touched on this already. It's the first of the twin engines. This is the fuel. Without robust, sustained growth in sales and profits, you're going nowhere. The L stands for longevity, in both the quality and the growth. A 100-bagger doesn't happen overnight. The average one in the study took 26 years. This means the company's competitive advantages must be durable, and its growth runway must stretch far into the future. It needs staying power measured in decades, not quarters. And finally, P stands for price is favorable. This doesn't mean you need to find stocks in the bargain basement. As Thomas Phelps observed, good stocks are seldom without friends. They're rarely dirt cheap. But you can't overpay either. There's a delicate balance here that we'll explore. Let's dive deeper into that Q for quality, because this is where the magic really happens. What defines a truly high-quality business? As Warren Buffett says, a great business must have a durable moat. A moat is some form of sustainable competitive advantage that protects it from competitors, just like a water-filled moat protected medieval castles from invaders. These moats come in different flavors. It could be a powerful brand. Think of Tiffany's. People pay a premium just to get that iconic blue box. That emotional connection is a moat. It could be high switching costs. Consider your bank. There's hardly any meaningful difference between most banks. But the sheer hassle of changing all your automatic payments and direct deposits keeps you locked in for years. That friction, those switching costs, form a moat. It could be network effects. Think Facebook or YouTube. The more users they have, the more valuable they become to everyone, creating an almost insurmountable barrier for new competitors. That's a moat. Or it could be a cost advantage. If you can deliver a product or service cheaper than anyone else, like Walmart does, that's a formidable moat. This moat is what enables a company to earn high returns on its capital year after year. And that brings us to perhaps the single most important, most central concept in this entire book. It's the absolute key to finding 100 baggers. It's not enough for a business to be profitable. What matters is how much profit it generates relative to the money invested in the business. This is often measured by return on equity, or ROE. Imagine you start a simple shoe shine stand. You invest $100 of your own money for brushes and polish. In your first year, you earn $25 in profit. Your return on equity is 25%. That's a high-quality business. Now here's where it gets magical. The true path to a 100-bagger is finding a business that can not only earn that exceptional 25% return, but can then take those $25 in profit and plow them back into the business to earn that same 25% return year after year after year. This is the raw power of compounding. That continuous reinvestment at high rates creates the snowball effect. A company that can consistently compound its intrinsic value at a high rate is the holy grail. Chuck Uckrey, a legendary investor who's owned multiple 100-baggers, distills his entire philosophy into three things: an outstanding business, talented management, and, this is the kicker, a business with abundant reinvestment opportunities and a long runway for growth. He says the older he gets, the more he realizes this third element, The ability to reinvest profits at high rates is the most essential ingredient of all. If a business can compound its value at 20% annually, it becomes a 100-bagger in roughly 25 years. This is the mathematical engine powering these incredible returns. And it only works if the business has a strong moat protecting those high returns. But a great business alone isn't sufficient. The Q in our formula also encompasses high-quality management. And here's another powerful pattern among 100-baggers. They're often run by what are called owner-operators. These are founders or leaders who have enormous chunks of their personal wealth invested right alongside regular shareholders. They have serious skin in the game. Think Sam Walton at Walmart, Steve Jobs at Apple, Jeff Bezos at Amazon, or Warren Buffett at Berkshire Hathaway. When the person steering the ship is also a major owner, their incentives align perfectly with yours. They think like owners, not hired executives. They focus on building sustainable long-term value per share, not hitting arbitrary quarterly targets to maximize their bonus checks. They treat the company's money as their own, because it largely is. A fascinating book called The Outsiders studied 8 unconventional CEOs who generated breathtaking shareholder returns. What united them? They were masters at capital allocation. They were brilliant at deciding what to do with the company's profits. Should they reinvest in the core business, acquire competitors, buy back their own stock? They thought like investors, not corporate bureaucrats. Henry Singleton at Teledyne was one of these outsiders. During his tenure, he bought back 90% of the company's stock. An investment with him turned into a 180-bagger. John Malone at TCI, a cable company, was another. He transformed every dollar invested with him into $900. Finding a business with exceptional leadership that has skin in the game gives you a massive edge. It's like betting on a jockey who also owns the horse. So we've covered small size, high growth, and high quality. What about that L for longevity? This ties everything together. A 100-bagger doesn't materialize overnight. The average one took 26 years to fully bloom. This means the company's moat must be durable, not some fleeting competitive advantage. Its growth runway must be long and wide. It needs to sustain its success for decades. This is why you must adopt the mindset of a long-term business owner, not a short-term stock trader gambling on price movements. And finally, that P for price is favorable. This doesn't mean you need bargain basement stocks. As Thomas Phelps noted, good stocks are seldom without friends. They're rarely dirt cheap because other smart investors recognize their quality. But you can't pay a ridiculous price either. There's an art to this. Peter Lynch explained it with elegant math. A company growing at 20% per year that you buy at 20 times earnings is a far superior investment to a company growing at 10% that you buy at 10 times earnings. They might appear equally priced relative to their growth rates. But over time, the faster grower creates so much more intrinsic value that it quickly justifies the higher initial price tag. After 10 years, the 20% grower's stock will be worth nearly 5 times as much as the 10% growers, assuming their valuation multiples stay constant. The key insight is not to shy away from a seemingly expensive stock if the business quality and growth prospects are truly exceptional. But ideally, you want both engines working for you. A business you can buy at a reasonable multiple that has potential for that multiple to expand as its growth story becomes clear to the broader market. There's one more powerful tool that great companies, especially those run by outsider CEOs, use to accelerate returns: stock buybacks. When a company uses its profits to repurchase its own shares from the open market, it's like a modern version of something called a tontine. In a tontine, as participants died, their shares got canceled, and the remaining participants owned increasingly larger slices of the pie. Stock buybacks work the same way. As the share count shrinks, each remaining share represents a bigger ownership stake in the business. Future earnings, dividends, and assets get concentrated among fewer owners. AutoZone is a perfect example. Over 13 years, the company retired 75% of its shares. The result? The stock was a monster winner, compounding at over 20% annually. For long-term shareholders who simply held on, it was like watching a slow-motion going private transaction unfold in broad daylight. When a great business run by a smart owner-operator is buying back its stock at reasonable prices, it's rocket fuel on the path to 100-bagger status. And if you're hunting for these elephants, you can't use a shotgun approach. You need to be concentrated. The book discusses something called the Kelly criterion, a mathematical formula for determining optimal bet sizing. We don't need to dive into complex formulas, but the principle is straightforward. When you have a truly great idea, you bet meaningfully on it. Look at how the world's best investors structure their portfolios. They don't own hundreds of stocks. They own a concentrated collection of their very best ideas. Seth Klarman, Manish Pabrai, Bill Ackman, they all run highly concentrated portfolios. Warren Buffett famously said he can't be involved in 50 or 75 things. He calls that a Noah's Ark way of investing. You end up with a zoo. If you want a 100-bagger to genuinely transform your life, it needs to be a meaningful portion of your portfolio. You can't diversify away your shot at extraordinary returns. Finally, you must build a powerful filter to block out the noise. The financial media, the daily market gyrations, the endless predictions about the economy, the perpetual speculation about what the Federal Reserve might do next, all of it is distraction and interference. Christopher Mayer shows a fascinating heat map of Monster Beverages' stock performance, month by month over more than a decade. It's a chaotic sea of red and green. Some months, the stock plunged 20, 30, even 40%. Other months, it soared just as dramatically. But the underlying business, a beverage company, didn't change that wildly from month to month. The real story was unfolding slowly over years. An investor watching the stock price daily would have been shaken out of their position a dozen times. The one who focused on the business fundamentals and ignored the noise would have turned $10,000 into $1 million. You must learn to tune out the market. As Benjamin Graham observed, most investors, quote, take the market and themselves too seriously. They spend a large part of their time trying, valiantly and ineffectively, to do things they can't do well, like forecasting the economy or predicting where stocks are headed next. Even during the bleakest market periods in history, incredible opportunities existed. Between 1966 and 1982, the Dow Jones Industrial Average went absolutely nowhere for 17 brutal years. It was a miserable time for the overall market. Yet the author's research uncovered 187 different stocks during that same period that went on to become 100 baggers. The opportunities are always there, in roaring bull markets and terrifying bear markets. You just need to be looking for them. And once you find one, you must be an extremely reluctant seller. As Phil Fisher wrote, if the job has been correctly done when a common stock is purchased, the time to sell it is almost never. You sell when you realize you made a mistake about the business fundamentals. You sell when the business no longer meets your original criteria. You do not sell because the price dropped. You do not sell because the price went up. And you certainly do not sell because you're bored and craving action. An old money manager once observed, "You make more money sitting on your ass." It might lack elegance, but it's one of the truest statements ever made about investing. If you're hunting for 100 baggers, you must master the art of sitting still, buy right, and sit tight. That's the path. As we wrap up our journey through 100 baggers, I want to leave you with a few parting thoughts. What this book really offers isn't some secret formula or magic bullet. It's a fundamental shift in how you see investing. It's an invitation to abandon the frantic, short-term mindset of someone treating the stock market like a casino, and instead adopt the patient, long-term perspective of a true business owner. The most powerful lesson for me is this radical idea that real wealth creation often comes from doing less, not more. The stories of the coffee can portfolio, of investors who held on through stomach-churning volatility, they all point to the same truth. Our greatest enemy in building lasting wealth is often our own impatience. We live in a culture that worships action, speed, and constant optimization. But this book reminds us that in the world of compounding, time is the magic ingredient, and patience is the ultimate superpower. The principles we've explored: finding small companies with long growth runways, insisting on high-quality businesses with durable moats, backing talented owner-operators, and buying at sensible prices. These aren't just investing rules. They're principles for making sound long-term decisions in any arena of life. It's about focusing on quality, aligning yourself with exceptional people, and giving your best ideas the time and space they need to flourish. So how can you start applying these ideas today? Here are a few practical steps. First, create your own mini coffee can experiment. You don't need to invest a fortune. The goal is to train your mind. Pick just 3 companies that embody the qualities we've discussed: a strong moat, a long runway for growth, capable leadership. Put a modest amount of money into them and make a solemn promise to yourself that you won't sell or even check the prices for at least 5 years. This single exercise will teach you more about the power of patience than any book or course ever could. Second, start studying the masters directly. Stop reading the daily market noise. Instead, go read the annual shareholder letters from Warren Buffett at Berkshire Hathaway or Chuck Akre at Akre Capital. These are freely available online, and they're master classes in business thinking. Pay attention to what they focus on. It's always the long-term economics of the business, never the short-term noise of the market. And third, become a reluctant seller in all areas of your life. Whether it's an investment, a project, or a relationship, before you decide to quit or move on, ask yourself, have the fundamental reasons for my initial commitment actually changed? Or am I just getting impatient or bored? Learning to distinguish between a genuine mistake and a temporary rough patch is a skill that will pay dividends far beyond your investment portfolio. The quest for a 100-bagger is more than a financial goal. It's an exercise in discipline, in long-term thinking, and in trusting the power of compounding. It's a journey that forces you to become a better thinker, a more patient person, and a wiser steward of your resources. And that transformation, ultimately, is a return far greater than 100 to 1. We've explored the core ideas of 100 Beggars by Christopher Mayer today, and I genuinely hope it sparked something in you. But a summary, no matter how thorough, is like looking at a map of a beautiful country. The map can show you where to go, but it can never replace the experience of actually walking the trail, feeling the fresh air, and discovering the hidden vistas for yourself. The real magic happens when you engage with the book directly. If the idea of finding even one of these life-changing investments has captured your imagination, I encourage you to grab a copy. Reading it isn't just about gathering information. It's an experience that can fundamentally reshape how you think about building wealth and securing your future. You'll find a link to the book in the description below. And if you found this conversation valuable and want to continue exploring ideas from the world's most brilliant minds, please take a moment to hit that subscribe button. That way, you won't miss our next journey into another game-changing book from the billionaire's bookshelf. Let's keep learning and growing together.